Everything you see on this page is done automatically, algorithmically, and it's everything that is going on in the market. Let me explain something to you. First, today is Sunday, April 6th at about 11:30. Alan Greenspan, the maestro, the chairman of the Federal Reserve back during the Reagan years, was asked one time, what is the one market signal, the one market tool that he looks at every day? What was it? Not the Wall Street Journal, not CNBC, but the interest rate of the 10-year Treasury. This one right here. It's the 10-year Treasury. I'll click on it. This one. The yield on the 10-year Treasury, you just move the decimal point. It's not 39.85. You just move the decimal point, and on Friday it closed at 3.985. That is the yield on the 10-year Treasury. The yield on the 30-year Treasury isn't 43.88, it's 4.388. That's the precise yield. This yield on the 5 isn't 37, it's 3.7. So if you bought a 10-year Treasury on Friday, the yield you're getting is 3.985. Of course, if you bought Treasuries a week ago, yielding, much higher, your bond is worth more because it has a higher yield, right? As yields go down, bonds go up, right? This is 90-day paper, short-term paper, and this is the problem. It is now at not 41, but 4.155. Give your money to the Treasury for 90 days, you get 4.155 interest rate. Give it to them for 10 years, you get less. Doesn't seem to make sense, does it? Well, that is what is inverting. And this I did not type in. This line here is mapping out the yield curve, the difference between the 10-year and the 90-day. Now back some couple of years ago, we can go back in time. Well, we can't go that further back, but I think it was November of 2022. And the yield curve inverted and not much happened. Historically, it doesn't work that fast. There's a lag to it. And the yield curve for nearly 15, 16, 18 months was inverted. And then as we approached the hopium of a new president in November, the yield curve went positive. And now the yield curve is going negative again. This setup where the yield curve is negative for 15, 16, 18 months, and then shortly goes positive and then rolls over, is actually the signal, historically, since folks have been tracking this, that the economy is now not just stalling, but going into a recession. Now, it doesn't work, on a string, although in the last couple of days. So all this focus and attention on the tariffs by Trump, yes, it may have been that one additional snowflake that triggers the avalanche, but the avalanche was building, and it has been building. Now, I think what's going to have to happen in the not too distant future, depending upon what happens on Monday and Tuesday, if the markets get whacked again and these interest rates fall, because they fell quite hard, 70 basis points, almost 100 basis points. If they continue to fall as the market dumps, we believe the Fed will intervene. And what will they do? They will cut short-term interest rates. If they cut them now 50 or 60 basis points, we would reinvert. Now, it doesn't work on a string like that, but it would signal to the market that the Federal Reserve is paying attention and is in the game. Question is, are you? Hopefully you are, by virtue of even watching this video. It wouldn't be all bad, but I think they're gonna wait. They don't want to be perceived as acting in an emergency, as not having it planned out. So they might want to wait a week or two. But the next move on the Fed will be to cut interest rates. And that may not be all bad. It'll take some of the pressure off this recession fear. But I don't think a recession is off the table. I don't think so. It's just going to be a question of how hard that recession is and how long it is. So they don't want to act precipitously in too soon, but the way they'll get us out of here will be to cut short-term interest rates. The question is, they may have to do it repeatedly. I would not want to be shorting bonds here. Growth stocks in a recession, growth stocks, technology stocks will suffer. The growth part of the economy. Things like utilities, healthcare, staples, supermarkets, maybe like Costco. Those things probably do okay. But the luxury end of the markets, the speculative stuff, may not. I'm Baggett at StockMarketCaddy.com. We have eyes on the market every day from a trader's point of view. And if you want to see what the yield curve is doing every night, you can subscribe to StockMarketCaddy.com for $100 a month. $100. Talk about value. What could that have saved you? If you want these tools on your desktop so that you get to make your own calls, manage your own little hedge fund, your own little portfolio from your own hard work, you can become an annual member. I invite you to visit StockMarketCaddy.com. If you have questions, feel free to give me a call at 813-758-8263. No more than COVID was responsible for the 30% correction. They would have you believe that. That's where they pinned the tail on the donkey of COVID. They're going to pin the tail on the donkey of these tariffs. It may have sparked, but it is a function of interest rates. And the banks in particular, do not want you angry at them or angry at the Federal Reserve. But it's the Federal Reserve and the banks, starting in 2008, that artificially controlled these interest rates, that created and got people addicted to debt in this bubble. And now they are trying, or Trump is trying to end it, get us out of that addiction and get the country back to work for strategic reasons, for generational reasons. The volatility in the market will be tremendous. And those who have learned how to trade in the markets will benefit greatly. And that's what we do, folks, for better or for worse. And if this is something you want to do, trade the markets, minimizing the emotions of fear and greed, and maximizing your time and your capital, extracting cash flow from the money flow, we're ready when you are. Have fun.